Hi, this is Mrs. Unruh again, and in this demonstration we're going to look at an example similar to exercise 15.9 to talk about the net present value method again, but this time we're going to be looking at what's called an annuity. In exercise 15.7, the cash flows from our piece of equipment that we were trying to decide whether or not to purchase, the cash flows each year were different. But in this exercise, we're going to see that the cash flows each year are the same, and that is the definition of an annuity then. An annuity is a flow of payments that is the same each year. In this exercise, we have a different company, Connor Company, who is considering, or that is considering purchasing equipment for $270,000. The expected life of the equipment is 9 years. And that equipment is not expected to have any value at the end of those 9 years. The equipment is expected to generate revenues of $150,000 per year and expenses, including depreciation, of $120,000 a year. The instructions also tell us that this company has a minimum acceptable rate of return, in other words, a desired rate of return of 12%. In other words, the company wants to earn at least 12% annually on any investment of this type. So to do this problem using the net present value, if you remember from the previous demonstration, the net present value always considers cash flows, not net income. Now, revenues, if that word were used by itself, that could be a problem, because revenues is not a cash basis concept. It's an accrual basis concept, but this tells us that it's cash basis revenues, so that's fine. We can use the $150,000. But these expenses that they tell us about, the $120,000 a year, those expenses include depreciation. Depreciation is not a cash basis amount. Remember, depreciation is just an accounting entry where we spread the cost of equipment over different periods. So what we're going to have to do to get to the net cash flows is subtract cash basis expenses from cash basis revenues. In order to do that, we're going to have to subtract the depreciation. This problem doesn't tell us what the depreciation is, so we're going to have to calculate it. In A, then I'm going to start by calculating the depreciation on the equipment so that we can subtract that from the accrual basis expenses, and then we can get to net cash flows. So to calculate depreciation, the problem tells us that this company is using the straight line method and that this equipment has no residual value. So the depreciation is simply going to be the cost of $270,000 divided by the 9 years of life. And that's going to give us an annual depreciation of $30,000. To then get to the cash paid out, in other words, the cash basis expenses, we will start with $120,000 of total expenses. We will subtract the $30,000 in depreciation, which is included in that $120,000, and that will give us $90,000 of cash basis expenses each year. And then from that we can calculate our cash basis net, our net cash flows. So we're going to have $150,000 of cash coming in minus $90,000 of cash going out equals $60,000 of net cash flows each year. So we are wondering whether or not it's a good investment to purchase this equipment for $270,000. It's going to last us 9 years, and each year it's going to either save us $60,000 or it's going to make us an extra $60,000 in cash flows. So the question is that a good deal? Is that going to earn at least 12%? In order to find that out, we need to calculate what's called the net present value. If you have not watched the video for exercise 15.7, I recommend doing that. I'm not going to go over the whole thought process for this method. I'm going to jump right to what's different in this problem, and that is the fact that we're going to be using an annuity table instead of a present value of $1 table. But first of all, we're going to go down here and calculate, or just repeat, the annual net cash flow. That's $60,000. Then, to calculate the present value of the net cash flows, if we were making $60,000 a year for 9 years, the future value of all that 9 years of cash flows would be $540,000. But we don't want to know the future value. We want to know what that $540,000 is worth in today's dollars. So in order to do that, we could do that one of two ways. We could take $60,000, again using the 12% rate because that is the company's desired rate of return. We could take $60,000 times 0.893, that would be the 1 year factor, plus $60,000 times 0.797, the 2 year factor, plus $60,000 times a 3 year factor, and so forth, all the way down through year 9. We could do that because that would be 9 separate cash flows, single cash flows. But there's a much easier way to do that. When you have an annuity, when you have a cash flow that is the same each year, you can simply take that annuity times the factor in your present value of an annuity of $1 table. Now let's take a second to see what's happening here. Notice in this column that the factor for 1 year is the same as the factor in our present value of $1 table, 0.893. Notice the factor after 2 years, 1.69, is simply an addition of these two amounts. In other words, the present value of an annuity table just does the work for us. It adds up these factors for us. So when we get down to 9 years, the table has added up all 9 of these factors for us. So instead of doing 9 calculations, we can do 1 calculation. We can take our $60,000 annual net cash flows times our present value of an annuity factor of 5.328, and we will calculate $319,680. So the $60,000 a year for 9 years presented in today's dollars is $319,680. In other words, if we invested $319,680 today and we got $60,000 a year back for the next 9 years, that would tell us, or that's what we would earn if we were earning a 12% annual interest rate. But this problem tells us that we only have to invest $270,000 in order to get those returns of $60,000 a year. To calculate the net present value then, net meaning after subtracting something, we are going to take our $319,680 of present values minus the cost of the equipment, and we're going to see that this project or this piece of equipment has a net present value of $49,680. So just like in the last exercise, we see a positive net present value, a present value greater than 0, which tells us that this equipment is earning the company more than 12%, more than their minimum required rate of return. In other words, as I said before, if we were earning 12%, we would have to invest $319,680 today, but we can invest $49,000 less than that. We can invest $270,000 today and get those same returns. That's $60,000 a year, which means this project is giving the company more than a 12% rate of return. So keeping that in mind, let's answer this last question. Which one of these is true? A, the analysis supports the purchase of the new equipment. Now, keep in mind that we're looking at this in isolation. We are not considering that there might be other better investment alternatives out there. Just considering this as maybe the only investment that the company is deciding on right now. Does the analysis support the purchase of the new equipment? Yes, it does, because it's earning more than 12%. It has a positive return. So that first half of option A is correct, because the present value of the equipment's net cash flows exceeds its cost. That's true. So maybe the answer is A. Let's look at the rest of these. The analysis supports the purchase of the new equipment. Yes, it does, because the present value of the equipment's net cash flows is less than its cost. No, that is false. So it can't be B. The analysis supports the purchase of the new equipment. Yes, it does, because the present value of the equipment's net cash flows is equal to its cost. No, that's not true. Can't be C. And the last one, the analysis does not support the purchase of the new equipment. No, that's not true, because the net present value is negative. No, the net present value is positive, which means it is a good investment. So our answer is A. And you can again see from this problem that it is just like the one in exercise 15.7, except that we had to calculate the net cash flows each year, and we learned that we can use the present value of an annuity table when we have cash flows that are the same each year.